So my question is, can it happen again? Will Credit Suisse be at the center of the next big financial crisis?
Sue, this is a bank that's really been struggling to recover.
The British pound hitting an all-time low today against the dollar. £1.
Is Europe heading towards one of the biggest banking crises like that of 2008? What are the factors contributing to the potential crisis in the European banking sector? What role does Credit Suisse play? In this video, we'll explain the global banking collapse and why the euro is doomed. We'll also look at the causes of the 2008 banking crisis and how they may be replicated in today's economic environment. So sit back, relax, and learn with us. Starting off with, what is Credit Suisse and what are the two significant incidents that took place in it in the past year? The Credit Suisse Crisis Barometer study of 2019 has revealed a worrying trend that could be indicative of the start of such a crisis. This study found that not only are banks at risk from economic and technological changes, but they're also vulnerable to geopolitical risks such as Brexit and the ongoing trade dispute between the US and China. A multinational investment bank and provider of financial services, Credit Suisse Group AG, was founded in 1856 and is headquartered in Switzerland. One of the 9 global bulge bracket banks, with its headquarters in Zurich, it has offices in all of the major financial centers around the world and offers services in wealth management, personal loans, asset tracking, and service management. It's renowned for its stringent banking secrecy and client confidentiality. It is regarded as a globally significant and systemically important bank by the Financial Stability Board. The Fed's major dealer and counterpart in foreign exchange are Credit Suisse. 2021 saw a loss of 3.7 billion Swiss francs for Credit Suisse's investment bank, which was followed by a loss of 992 million francs in the first half of 2022. The collapse of the US fund Archegos, which cost Credit Suisse over $5 billion, seemed to have an impact on it. In particular, Credit Suisse suggested to multiple clients that they invest up to $10 billion in Greensill Capital. Greensill performed a comparable function to a lender by mediating transactions between vendors and clients. In other words, it changed the role of suppliers, who previously had to wait for payment from clients. Companies like Credit Suisse helped the company attract a lot of funding and interest. Following massive losses in the third quarter, Credit Suisse announced a number of dramatic actions on Thursday, October 27th. These included restructuring its investment banking division, eliminating 9,000 jobs, and raising new capital. The market environment was not favorable when the announcement was made on Thursday. The third quarter saw lower demand for transactions such as debt issues, initial public offerings, mergers, and acquisitions due to heightened market volatility brought on by Russia's war in Ukraine and recession fears. On Tuesday, UBS, the largest bank in Switzerland, announced a decline in income in its investment bank business, similar to the major US investment banks. Heavy losses from Credit Suisse's capital-hungry investment banking division have caused the company to go into the red, overshadowing its other, more reliable businesses like fund management and Swiss internal financing. So now that the Credit Suisse crisis is cleared, let's learn about what exactly happened in 2008. But before that, let's quickly review mortgage-backed security. So what is mortgage-backed security? A mortgage-backed asset resembles a bond in many ways. It's made up of house loans that have been packaged and sold by the banks to Wall Street investors. Profiting from the loan interest that mortgage holders pay is the goal. Millions were persuaded to borrow money beyond their means to purchase homes they couldn't afford in the early 2000s by loan originators. After then, the loans were transferred to investors as mortgage-backed securities. The homeowners who had taken on debt beyond their means inevitably started to default. As a result of falling housing prices, millions of people abandoned mortgages that exceeded the value of their homes. Getting back to the 2008 banking crisis, years of historically low interest rates and loose lending regulations contributed to a housing bubble in the US and elsewhere, which helped create the conditions for the financial crisis. Things started out, well, as usual. In response to the September 11 terrorist attacks, the collapse of the dot-com boom, and a number of corporate accounting scandals, the Federal Reserve cut the federal funds rate from 6.5% in May 2000 to 1% in June of 2003. It was meant to stimulate the economy by providing consumers and businesses with inexpensive access to money. Because borrowers took advantage of the low mortgage rates, the value of homes started to climb quickly. Even subprime borrowers, those with bad credit histories or none at all, could fulfill their ambition of owning a home. The Wall Street banks acquired the bank loans, packaged them, and sold them as low-risk financial instruments, including mortgage-backed securities and collateralized debt obligations. A large secondary industry for the creation and distribution of subprime loans quickly developed. In order to encourage banks to take on greater risk, the Securities and Exchange Commission decreased the net capital requirements for 5 investment banks in October 2004: Goldman Sachs, Merrill Lynch, Lehman Brothers, Bear Stearns, and Morgan Stanley. They were able to multiply their initial investments up to 30 or 40 times thanks to that. Homeownership eventually reached its saturation point as interest rates began to increase. The federal funds rate reached 5.25% 2 years after the Fed began hiking rates in June of 2004, and it stayed there until August of 2007. Early indications of distress were present. Home ownerships in the US reached a peak of 69.2% in 2004. After that, property values began to decline in early 2006. For many Americans, this was quite difficult. The value of their properties was lower than what they paid for them. They owed money to their lenders, therefore they were unable to sell their homes. If they had adjustable rate mortgages, their expenses increased as the value of their properties decreased. The most vulnerable subprime borrowers were forced to stay in mortgages that they couldn't actually afford. One subprime lender after another declared bankruptcy as 2007 got underway. More than 25 subprime lenders failed in February and March. Subprime loan specialist New Century Financial filed for bankruptcy and fired half of its staff in April. Now, before we move on to the other banks, if you're not subscribed to the Biz Studied YouTube channel, you need to subscribe before the end of 2022. We're trying to break to 50,000 subscribers, so please subscribe so we hit our goal and reach many more people. We promise the next video will be even better, so please subscribe, and thank you so much. Back to the video. Bear Stearns halted making redemptions in 2 of its hedge funds before the end of the month of June, which prompted Merrill Lynch to seize $800 million in assets from the funds. Even these were insignificant issues in light of what lay in store for the upcoming months. The circular economy that keeps money moving around the world is shut down due to widespread confusion. Northern Rock had to ask the Bank of England for emergency capital due to a liquidity problem. The Swiss bank UBS was the first significant bank to disclose losses on assets linked to subprime mortgages in October 2007. The sum of their losses was $3.4 billion. The Federal Reserve, as well as other central banks, will lend billions of dollars to the global credit systems in the coming months as they collapse due to declining asset values. Financial firms were having difficulty estimating the value of the risky mortgage-backed assets that were still recorded on their books and were worth trillions of dollars. By the winter of 2008, the US economy had fully entered a recession, and as financial institutions battled to retain liquidity, stock markets throughout the world had their worst plunge ever since September 11th. By the summer of 2008, the financial industry was being decimated. The 2 largest home lenders in the nation, Fannie Mae and Freddie Mac, were taken over by the government of the United States, and IndyMac Bank became one of the biggest banks to fail in American history. However, the collapse of the legendary Wall Street bank Lehman Brothers in September, which was the largest in American history, came to symbolize the devastation caused by the global financial crisis for many. When the stock markets were in free fall during that same month, the major American equities suffered some of their biggest losses ever. In the financial industry, bubbles frequently occur. A stock's price or the price of any other commodity may rise above its true value. The impact is typically restricted to losses for a small number of overly enthusiastic consumers. There was a distinct kind of bubble during the economic meltdown of 2007 to 2008. Like very few others in history, it got to a size that, when it burst, it injured millions of people, many of whom weren't investing in mortgage-backed securities, and devastated entire economies. But now what's more horrific is that history is repeating itself. The banking sector of Europe is in real danger. A year ago, the market value of Credit Suisse was $22.3 billion. Its current market value is only $10.4 billion, and the shares have fallen by 56.2%. Additionally, its CDS prices have risen to their highest possible level since 2008. A CDS provides insurance against a company's bond default financial derivative known as a credit default swap, and enables an investor to exchange or offset their default risk with those of another investment. The lender purchases a CDS from another trader who agrees to pay them back if the borrower fails to pay in order to swap the default risk. Although these levels are by no means distressed and are a result of general market sell-off, experts feel they represent a decline in market judgments of creditworthiness. Its employee motivation has reportedly been low, and the bank has yet to extend the contracts of some of its contractors. Jens Welter, a senior dealmaker at the bank who spent 27 years with the company, just left to join Citigroup. One of the 30 banks judged too big to fail internationally is Credit Suisse, compelling it to keep aside additional funds to withstand the crisis. Therefore, banking professionals are slamming social media speculations that surfaced earlier this month about a Lehman Brothers moment, referring to the US bank that failed and precipitated the financial crisis in 2008. These speculations assisted in driving its share cost down to a minimum of 3.158 Swiss francs, even though many industry experts believe bankruptcy to be highly impossible. On the main SMI index of the Swiss stock exchange, Credit Suisse shares extended trading on Wednesday at 4.763 Swiss francs. Spencer Jacob, the editor of the Wall Street Journal, examined the remarks made by the two CEOs in order to make comparisons regarding the circumstance. "I trust that you are not confusing our day-to-day stock price performance with the strong capital base and liquidity position of the bank. Our capital position is strong at this time," said the Lehman Brothers CFO. $600 billion, what Lehman Brothers possessed in assets before they failed and took the economy with them, tweeted Graham Stephan, a well-known analyst of U.S. equity markets. AUM held by Credit Suisse and Deutsche Bank is $2,800 billion, 4.5 times more. According to the CEO, Credit Suisse is currently in a critical moment. What does the future hold for the globe? He continued by saying that the equities of banks had already experienced a complete collapse, with a 40% drop in just 1 year. These banking crises for Europe might become more violent than in 2008 because of the ongoing Ukraine war crisis, which was not present before. The Credit Suisse study is a wake-up call for Europe to act on the risks associated with its banking system and take measures to protect itself from an economic meltdown similar to what was experienced in 2008. By increasing transparency, strengthening regulations, and ensuring that banks have proper risk management practices in place, Europe can look to a brighter and more secure future. With the right measures in place, Europe can confidently tackle the challenges that it faces with greater assurance and security. Only then can Europe truly be ready to face tomorrow's opportunities with confidence. This is what European leaders must strive for if they wish to ensure a safe and prosperous future for their citizens. That was all for today, folks. Hope this video cleared your point of view regarding the ongoing European banking crisis. Do you think that Credit Suisse can overcome its current situation and stop itself from going bankrupt like the Lehman Brothers in 2008? Share your opinion in the comment section. Do like, subscribe, and press the bell icon for more. And